Okay, well, I think we'll go ahead and get started. Hopefully everybody can see the screen and hear me just fine. If you are having trouble seeing anything, please go ahead and put something into the question box. And that goes for any questions that you have going throughout the webinar. Be kind of keeping my eye on it on my other screen, so should be able to see questions as they come up. I'll also pause throughout the webinar just to see if we've missed anything, but feel free to put something in there. And again, if you're having trouble seeing, just let me know and try and get that fixed. But appreciate everyone who has joined us today. I would like to just give a brief overview of the fuel budgeting program and talk about some of the partnerships that we have to create this program and why we have done so. Today, we'll have three speakers. First is myself, Brian Carmen, Program Development Director at the Indiana Bond Bank. We'll just give an overview of the fuel budgeting program and what we'll be talking about today. I'll then hand it over to Russ Pollock from Maverick Energy Consulting, who will kind of give an overview of the fuel market and what we might expect to see over the next year or so, and how the fuel program offered through the Indiana Bond Bank might be beneficial in that regard. And then finally, Ron Mangus, our Director of Operations here at the Indiana Bond Bank. I'll go into a little bit more detail about the different structures of the program and maybe some of the myths that exist about what the purpose of that program is as well. So I'm going to go ahead and jump right in. Again, just a quick overview, talk a little bit about what the program is, what it means, and why you should protect your fuel budget. Debunking some of those myths that exist about what this program is and what the purpose is. Again, Russ from Maverick Energy Consulting will talk a little bit about the current fuel market indicators and what that might mean for the future. Give an example of the program participation and what next steps and how to get involved. And then finally, just a Q&A at the end. But again, feel free to put your questions in throughout the webinar. So what is a fuel budgeting program? Essentially, this is a program offered through the Indiana Bond Bank that serves as a financial risk management tool to protect your fuel budget against the volatility of the fuel market. So this really has nothing to do with where and when and how you buy your fuel. It's about protecting the budget that you've set for this year or perhaps the next 2 years against a market that quite frankly, we just have no control over. The program has existed since 2009, in which the Bond Bank has protected over 26.7 million gallons of fuel for local units of government. And on that note, local units of government are our participants in this program, and that's really everything from a county to a city to a school system, anybody who really has a fuel budget and transportation costs throughout the year. Might benefit from this program. One of the great things is that it really is a program designed for both small and large. It usually could be more expensive for a small entity to hedge gallons of fuel in the way that we will be presenting this program. But because the Indiana Bond Bank has a statewide network of local units of government that participate, we're able to pool those entities. And I'll talk a little bit more about that later. But going back to what the program is, it's access to a risk management tool again that the Bond Bank offers with a team of experienced professionals, whether it be legal counsels or Maverick Energy, and just the experience of running the program since 2009. And I mentioned this before. The program is designed specifically to achieve efficiencies gained by pooling with other participating units for lowest administrative fee annually. So what you'll find as we go into the program, the fee that's associated with this is reduced the more entities that participate in the program. In 2020, we will see an all-in fee of no more than 5.5 cents per gallon. We will set that once we do have all applications in, but we can tell you now that that will not exceed 5.5 cents per gallon. So a good way to think about the fuel budgeting program is like any kind of insurance policy. So whether it be health insurance or life insurance or something that would be maybe more relatable to Hoosiers here in Indiana is crop insurance, something that's not necessarily mandatory, but in the best interest of a farmer to invest in. And essentially, the reason they would do that is they don't have control over what might happen weather-wise or in the climate change. So if something happens to their crops or a natural disaster, they have insurance on those crops. And while it wasn't mandatory, if something happens, then they are protected. So similarly, as Ron will talk about later, based on the different structures of the program, when the fuel market prices adjust, if they go over a certain amount and you had only budgeted for a price that was maybe much lower than that, the bond bank can help subsidize the difference there based on our connection with experts in the fuel marketing industry on what that would look like. But essentially, it takes the risk away from you guys of having to predict what prices might be when you're setting your fuel budget. So you probably have a good idea based on last year and the year before and the year before of how many gallons of fuel you'll need to purchase in order for your local unit of government to operate. If you're a school system and you need to know how many gallons of fuel you'll need for school buses, you might hedge a certain amount against this fuel policy to this insurance policy to ensure that if fuel prices go over a certain amount, that you are still paying essentially the amount that you had budgeted for. So that's the whole idea of the program. Again, as far as some of these myths about what the program is, it's not a physical fuel solution. So we are not driving around in a Indiana Bond Bank fuel truck and providing the fuel itself. We are not asking you to change fuel providers, and we are not a fuel relationship replacement. So really not much changes on your end except for security and knowing that your budget is going to be protected against volatility in the fuel market. Again, bottom line here, fuel budgeting has nothing to do with the physical commodity of fuel, but rather everything to do with managing price volatility of a commodity that you consume. So when I turn it over to Russ in just a second, you'll see that the fuel market is unpredictable, is volatile, and when you set your budget for the year, you're going to want some sort of proactive security that you won't have to dip into other buckets of fuel as a reactive solution to the volatility in the market. And that's essentially what the bottom line of the fuel budgeting program that the Indiana Bond Bank offers is. And with that, I want to turn it over to Russ. Don't see any questions in right now. I'm going to turn it over to Russ and keep an eye on this question box. So feel free to put anything in as far as that basic overview of what the fuel budgeting program is. And Russ, I'll let you take it from here to talk about the fuel market.
Okay, thank you, Brian. Can you hear me okay?
Can hear you great.
Okay, good. Before I go into the fuel markets itself, I want to just add one thing to what you were describing there as far as, you know, what is the fuel program? What are the benefits of the program? And one of the things that, I'm not sure if Ron will go into it in a little bit here, but is the cost efficiencies with hedging and protecting your budget through the bond bank, say, versus just a straight fixed price with a local jobber. Within the last, and this has been going on for years and years and years, but the benefit of the bond bank is you're utilizing the A-rated entity of, you know, the credit rating of the state of Indiana and the partners that are involved in the program, whether it's the financial institutions, the consultants, whatever. It's extremely streamlined. And if I had to use a rule of thumb as to what do you gain by going through this process versus, like I said, just locking into a straight fixed price with a local supplier, it's about 20 cents a gallon more efficient to do this through the bond bank. So I just want to keep that in mind when Ron starts going through the analysis, and, you know, a lot of numbers will be thrown and this, that, and the other, but in the end of the day, there's about a 20 cent per gallon efficiency in the transaction itself, let alone when you start talking about, you know, the quantity or price per gallon that's being set. So I just want everyone to keep that in the back of your mind of how efficient this process is. So with that, I'll jump into the market. And the first slide that we have here is the RBOB, which is unleaded and diesel fuel prices since January 2016. I just want to highlight for you the volatility that we experience, the trends, etc. And then also want to just highlight for you that in 2019, you'll see where the hedge was set, which was very opportunistic. We were, I guess, fortunate. We don't necessarily set out to achieve the bottom of the market, but last year certainly did achieve the bottom. And from there, you saw the market run up through the first half of this year. It's been pretty choppy all summer long. And again, volatility and unpredictability of these markets is what the program is designed to protect against, not only on the upside, but also create some opportunity on the downside. Next slide, please, Brian. Okay. So overall, what we're seeing in the market, and this is a very, I'll say a macro point of view, there's probably 1,000 different things that we could look at, read, point to when looking at fuel markets from a global perspective. But in the end, oil prices, if you talk to producers, if you talk to other market participants, the cost or the price of oil is just too low. Maybe it always is, but right now they feel like it is too low. So there's a real strategic, either conscious or unconscious decision or steps being taken by market participants to really push up the price. So you're seeing production growth starting to slow, oil rigs are down. You've got, on a global footprint, you've got OPEC that is continuing to cut production and probably will do so inevitably. And ultimately, all of these things and these steps that are taking are going to lead to a higher refined cost for whether it's diesel or unleaded or whatever. So there's a lot of things that are happening from a supply and demand perspective, a storage perspective, all these different things that are moving around globally, really to try to support a higher cost of crude oil. Not to mention, you also have all of the, I guess, international concerns, geopolitical concerns that are happening across the globe as well, more so than we have had in the last 2 years. So at the end, you've got a political scene in the US that is, I guess, forming, right? And the fact that we have 2020 being an election year, you have Iran, North Korea, Venezuela, Russia, China, all these things being thrown at us. There's a tariff war going on. There's currency wars. The value of the dollar plays an important role in what's happening with crude. So my point with all of this is that there is a number of things that are going to impact the value of crude oil going into the future. Things that are, again, completely outside of our control in the Midwest in the United States. Brian, next slide, please. So fundamentally is what I just described on the last slide is some of the fundamental things, you know, supply, demand, production, you know, some of the geopolitical concerns, whatever, but there's also just the technical pricing pressure that this market experiences day in and day out. And the trend over the last year or so, we've seen the market come down from where we were a year ago. And when you look at those financial positions, the hedge funds are the owners of these positions, other speculative players, many believe that that market, crude, RBOB, diesel, all of it is oversold. So the concern is that with these technical pricing concerns, so whether or not the market is supported or resisted from a technical trade perspective, has nothing to do with fundamentals, but those technical concerns combined with the fundamental concerns certainly point to a more volatile market and one that, when measured out, certainly looks to support higher prices, it creates a scenario where higher prices are more likely than lower prices. So upside risk is greater than downside potential. Brian, next slide. So last year, what the bond bank program looked like, it was a price collar. So in 2019, for example, you had a range of basically $1.51 to $2.13 for diesel. Right now for calendar year 2020, that number is 170 to 215, and the floor is basically not as steep as it was a year ago. So what that is an indicator of is, again, that market is tightening a little bit, and that there's not as much downside potential in the market per the trades and per the measured volatility, et cetera, that is formulating the caps and the floors in the market. Next slide, please. So as a big picture item, I always throw this out there, if the insurance premium is a nickel or, 5.5 cents, whatever it ends up being for this year, what are you getting for your insurance premium? And in the end, 5 cents a gallon avoids a tremendous amount of risk. It gives you insurance against a catastrophic move higher, but it also gives you the benefit in the way that these things are structured with a cap or a collar, downside participation as well. So if the market does continue to slide, you will participate with the market on the way down as well. So it offers flexibility on both sides. So it offers you the opportunity to avoid all of the risks associated with global fuel markets, secure your budget, and then ultimately, participate if the market goes a little bit lower. And Brian, that's all I think all I have on the screen.
Yeah, no, thank you, Russ. So I think you can tell by Russ's presentation all the different factors that go in, and just to emphasize that point of this is really out of our control, and these are only some of the factors, and new things are bound to come up throughout the year that are going to impact fuel prices. And now that you know that the bond bank offers this tool as fuel budgeting protection, I want to turn it over to Ron Mangus, our Director of Operations at the Indiana Bond Bank, who's going to talk a little bit how the structures of the program actually work to help protect the fuel budget. So with that, I'm going to turn it on over to Ron.
Good afternoon. As Brian said, this is Ron Mangus. I'm the Director of Operations with the Indiana Bond Bank, and I have worked on this program in some capacity since we have started back in 2009. I'm going to talk very briefly about the mechanics of the program. Keep in mind, if you have any questions, we can do one of two things. I can answer them here, or we can reach out and have a phone call with you, or go to visit you physically and see if we can walk you through again how mechanically this program works, because we will make sure that everyone understands how settlement works. So there are several ways to protect your budget, but we're going to talk about two main ones. And the first one is called a cap. And how a cap works is that we're going to set a ceiling or a cap price, and that is going to be bought up front with a premium. And in this example that you have on your slide is at $2.50. So if the market price goes above $2.50, then the bond bank pays your entity in terms of protection of your fuel budget. However, if there is no downside, if the price goes below $2.50, and it doesn't matter how low it goes, there is no transaction between the bond bank and the entity. So again, how this works in this slide is if the price goes up above $2.50 and settlement is monthly, then the bond bank would pay you monthly the amount that it goes up. So in February, in this example, is at $2.75, the bond bank would pay you 25 cents per gallon that you participate in our program as protection. But in August, where it goes below $1.75, there is no transaction with a cap. And again, there is a premium in the cap. And you ask, well, what's the premium or what's the cost? Well, it depends on what level you set it at, but typically we've looked at anywhere between 8 and 15 cents. But that is something that we would discuss and let you know up front before we move forward. And that is 8 to 15 cents per gallon. Alternatively, in most of our schools, cities, and counties participate in our collar program. The difference between the collar program and the cap is, one, there is no upfront. Settlement is monthly, so there's no upfront fee or premium. However, there is a downside if the price goes below the floor. So you have a $2.50 cap and a $1.75 floor. And in this example, if the price goes below the $1.75 floor, as it is in August of this example, then your entity would pay the bond bank. Conversely, you'd have the same protection if it goes above $2.50. Like again, in February of this example, it would be 25 cents. You'd be provide protection of 25 cents per gallon. So, and then I have this slide that illustrates this a little bit differently on the next slide on monthly settlement. Again, there are three things that can happen for the cap, and this is what this outlines. You're participating at 65% of your consumption over 3,000 gallons. The assumed floor is $1.75. The assumed cap is $2.50. And in example one, if the price falls below the NYMEX price, New York Mercantile Exchange, falls below the floor by 20 cents, then you would pay the bond bank 20 cents per gallon. And if you look at the math here, it's 1,950 gallons time is your level participation times 20 cents, or you would pay $3.90. Conversely, in example 3, if the price goes to $2.68, that is 18 cents, and you would pay, the bond bank would pay you 18 cents or $351 if your participation was 1,950 gallons. And then finally, in example 2, nothing happens if it's within the range. So I'm going to walk you through the monthly settlement, and typically settlement happens about 5 to 10 days. You would be notified of what happens each month, and there's a gentleman by the name of Aaron Barnett who does that in our office. So again, another mechanical thing is just the process. Number one, entities can only hedge up to 80% of their estimated fuel volume. So what you would do is estimate how much fuel you would consume in 2020 on your application. You put that on your application, and then we'd allow you to hedge up to 80%. You can do anything less than 80, but up to no more than 80% of your anticipated fuel consumption. Once you submit your documents or your application, we would have counsel as part of the program provide you legal documents for your entity to adopt so you can participate. And then we would set the level of protection each year, and that is each calendar year for the collar. And that usually is in the middle of December. So we would keep you up to date on that. So again, to follow the process, applications will be due sometime in October. Entities determine level of participation. We set the protection in December. And the bond bank for the collar program does charge an administrative fee, and it will be no more than 5.5 cents per gallon. And that is based on the level of participation. In other words, how many participants we have in terms of gallons in the program. So here is a calendar with specific dates. We have a survey. The survey is not required. It just lets us know who is in and out of the program. We would ask that applications are in by October 18th. It is a 3-page application. It is on jot form. If you participate in the past, we would autofill the prior year's information where it can be filled in. Again, I mentioned that your entity would need to pass a resolution. Those dates are listed. And then final sign off. We would not do anything without telling you what the level of participation, what the fee is, and what the range that we were enter in. You will sign off on all those documents before we would move forward with a hedge. And again, we would enter into a hedge and most likely a collar, but we do an analysis to make sure that's the best for the pool. But we'd enter into that in December for the calendar year 20 for January through December. So again, frequently asked questions. Some of these have been covered before, but wanted to cover again. Again, we will not tell you where you purchase your fuel. You'll continue to purchase the fuel from your current vendor. And again, this program is a financial instrument to protect your budget against rising fuel costs. Another question that we get asked is, will we audit your fuel consumption? No, once you submit your application, we do not audit. We do not need receipts of what has been consumed. And finally, if you already fixed your price with your current vendor, then you cannot participate in the fuel program. However, we would like to take a look at that to see the fee that is built in, as Russ mentioned, is what is being charged in that fee and the fixed price, and see how that compares to with the bond bank program. Okay, at this time, Brian's going to go through a little bit of general information about the bond bank and what the bond bank is and who we serve.
Alrighty, thank you, Ron. I want to actually take a step back real quick and just go back to our timeline here. So we've got this program participation survey, which Ron mentioned. This is essentially just telling us upfront that you plan on participating in the program. It's going to be done really verbally. If you just give me a call, we can document it. But essentially what we want to know is how many QEs or local units of government are going to be participating, so we can start planning on what our hedge amounts are going to be. The program application will be coming out on Monday. I want to do a few last adjustments that were really for the benefit of anyone who's applying, just to make it easier, a more streamlined process. We wanted to actually get them out this last Monday, but realized we might be able to make a few adjustments that make the application process easier. So be on the lookout. Anyone who's on this webinar will get a notification of that. But we would ask anyone who is on this webinar to let us know of their intent to participate at this point, even before Monday, if possible, so we can start gathering that information. You will see that these applications can be completed via Word document, first via fillable PDF, and then via an online system called JotForm. We'll say that the benefit of doing it through the online system on JotForm will be that we'll be able to pre-populate all information for next year's application. And if you actually filled one out last year through that, you'll have about 3/4 really of your application completed already, and subject to updates on contact information. You did have ACH information in there last year. We took that out. We're going to approach that a little bit differently this year, really just for security purposes on all I have. But anyway, that program due date will stay the same on 10/18. But so be on the lookout, along with these PowerPoint slides and everything else for that application on Monday of next week. We will be at the AIM conference as well. I wanted to mention that in case you wanted to stop by. I want to give a chance for questions to be entered in. We did have one that came in that is, why is this any better than fixing price with my fuel vendor? And if Ron, I don't know if you want to take that, or if Russ, you want to jump in too, feel free.
Sure, I can touch base on that. So if you do a straight fixed price with a fuel vendor, that's what you have, is a straight fixed price. And that's certainly one way to go about it. But there's two things to keep in mind with that. Is one is typically the way that the fuel markets work, and the way that a local supplier would hedge it or offset the risk on their end for your transaction. The way that would work, they won't carry as much. How's it work? their cost of doing business is going to be higher than the bond bank. And it really comes down to the cost of credit. So when we've analyzed those types of transactions in the past, we're seeing a differential in the cost to transact as much as 20 cents a gallon. So again, the fixed price would give you some protection. I would say that it's an expensive methodology for doing it. Plus, when you do that, you do not have any downside participation at all. So yes, we think the market has a higher likelihood of going up from here than it does going down. However, it doesn't mean it can't go down. And if it does, you'd like to be able to participate. So those are the two biggest things in my mind when it comes to participating in this hedge program, and really removing the numerous layers in the process. You can still buy your physical fuel from that local guy. You have to. You just want to float the market with them. You don't want to do a fixed price to them. You're better off from a cost perspective doing that and performing that transaction financially through the bond bank.
Thanks, Russ. Yeah, just to add on, reiterate, transparent costs with the bond bank. As a quasi-state agency, we are created an Indiana code to help with affordable financing, and of course, with that, all of our programs have transparent fees and costs that are associated with participating in the program. We got another question that came in. How do you decide if a cap or collar will be used for the hedge? And Ron, I'll let you take that one.
So traditionally for our cities, counties, and for our school corporations, we've done a collar. And it does not mean for 2020 we will do a collar. What we did in 2019, we did a careful analysis and looked at what the market was for fuel and what was the best for the qualified entities, and we went forward again with a collar. Having said that, we will again do a careful analysis of the market, take a look at what's best for our participants, and then make that decision, and we will keep you informed of what that decision is. But traditionally for our cities, our school corporations and counties, we have done a collar. We do have a participant that does a cap, but it's a large participant and they do participate in a cap. So if you are interested in the cap and you're a large entity with large volume, you can reach out to us and we'll be glad to discuss that with you.
And also, Ron, I'll add one point to that too, is that the way that the process is set up is a qualified entity is not committing until they know exactly what the solution will be. So if we're doing the analytical work, you're not as a qualified entity, you have control over that final decision, whether you like a collar or a cap. When it comes to perform the hedge, all that final details will be laid out to you, and you still have the option at your discretion to participate or not.
Thank you, Russ.
One more question come in. If I use different amounts of fuel throughout the year, how does that work? So you'll see this in the application. We ask for the gallons that you project to expense for month by month. So that's perfectly fine. We do have a limit of 80% that can be hedged of your total fuel budget. But we can be flexible on how that looks, whether it's done monthly or on an annual basis, that 80% total. But we can work with your entity as far as how much you're going to hedge throughout the year. So it doesn't need to be an even amount throughout the year. It can fluctuate. So yeah, if you're a school entity, for example, and you know that your school buses aren't going to be running during the summer, certainly that would be a month where you wouldn't be hedging as many gallons, if any. So we would just work that out through the budget and the application and kind of work from there. But But yeah, so as far as fluctuation throughout the year, that is not a problem at all.
And Brian, let me add again, just to add to what Brian said here, is that you elect the amount that you're going to hedge. So if you want to change the amount, if you want to do more a certain month and less a certain month, you have the ability to do that.
Yeah, great point. So as I transition out of this timeline and just talk a little bit more general about the bond bank and allow for last minute questions to come in, going back to Ron's point and Russ's as well on how we set that cap and collar. That's part of the reason why this early indication of whether you plan on participating is so important to us and gives us an idea of what the total gallons hedge is going to look like and what might be appropriate to enter into, or if perhaps it makes more sense for someone to enter into their own hedging. So the sooner those are in, the better for us. Again, applications are out on Monday, but if you plan on participating, hope to let us know by tomorrow. So I do want to cover just a little bit the more general side of the bond bank outside of the fuel budgeting program, and allow for any questions to come in before we close out for the day. So I mentioned earlier, the bond bank is a quasi-state agency, which essentially means that we were created by Indiana code, but we do not receive any state appropriations. So we operate primarily as a private entity outside of that Indiana code. We were created to really achieve affordable financing for local units of government or even state governments. So that can be, as you see, the long list of different entities that we serve. Again, this is very small to very large local units of government. And the benefits of using the bond bank really are in that economies of scale. We kind of covered that earlier, being able to leverage the statewide network, combining both small and large entities to achieve efficiencies in financing, or even in these kind of more non-traditional programs as far as the fuel budgeting program, achieving those efficiencies through pooling, all-inclusive and transparent rates, and exempt to bid financing, which is a big component of our Hoosier Equipment Lease Purchase Program. It's existed since 1984, growing a great reputation, both with our business partners as well as our local units of government, and then the expertise of staff and professionals, with a combined experience of really 40 plus years. So some of the other programs that we offer, Hoosier Equipment Lease Purchase Program. So I mentioned we exempt the need to bid out financing for equipment purchases. So saving time and resources, we again kind of leverage a network of financial institutions and debt providers for equipment in order to get you the most affordable rates on that equipment lease purchase. Tax anticipation warrant program, which we refer to as advanced funding. So we understand that local units of government, big and small, both have issues with cash flow needs. So not that the cash isn't going to be there, but just maybe not there at the right time or the time that it's needed for operational costs. The bond bank has a program which assists with that, and we will be opening applications very shortly for that as well, so be on the lookout. Interim loan program, traditionally partnership with USDA Rural Development, providing construction costs for those longer, usually up to 40-year term projects on everything from wastewater to the construction of public libraries and so on and so on. And then our community funding resource program, which is typically for projects both small and large. This slide might actually need to be updated, but up to 10 years in financing. Right now rates are very low and working through some projects there, but it's kind of, I always refer to it as kind of a compass, moves in a lot of different directions as far as what kind of public projects can be done, whether it's sewage, wastewater, recreational, even equipment purchase, really can be very flexible if you're in the need for financing for under 10 years. We can provide that through that program. And I think we are good on questions. So I will just mention to close out, be on the lookout for a follow-up email. Please provide feedback on the webinar. I want to make sure that we are making the best of our time, your time, as far as how we present these materials. So if anything's unclear or could be presented in a different manner, please let us know. You'll have the opportunity to provide that feedback through a GoToWebinar service. Otherwise, be on the lookout for the information that I mentioned that will be coming along with the slide deck. This webinar will be recorded and posted to our website along with an overview of the application. We'll go through and just talk about what is needed and why, and maybe some frequently asked questions that we can avoid ahead of time. So it's a good place to start when you get the application, is just kind of a walkthrough. We'll actually be recording that on Monday morning and posting that with the release of the application. Again, we will have a booth at the AIM Summit coming up in French Lick next week. I will be there. I think Mark Wolnar, Executive Director, will be there for a day. So feel free to come and introduce yourself if you plan on being there. And we might be able to answer any specific questions that you have about this or any other bond bank programs. I just want to say thank you again for joining us today. Thank you to Russ and Ron as well for joining us. And as always, feel free to reach out with any questions, and we'll talk with you then. Thanks.